Now, there's another problem. It's even scarier, and this is a central banker's worst nightmare. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. So you can take rates to zero, but you're stuck. Could you have negative interest rates? In theory, yes. In Europe, Switzerland, and Japan did. But there's no evidence that it provided any stimulus. I mean, they did it, but it's like an experiment that didn't work. The problem with deflation is there's nothing a central bank can do, and it does feed on itself, and it does get worse, and that is a central banker's worst nightmare. However, a quick footnote, we did see this in the 1930s, well, between 1929 and 1933, during the first phase of the Great Depression. It was the Hoover administration. Then Franklin Roosevelt came in 1933. And Roosevelt faced exactly the same problem. I mean, he shut every bank in America on like his second or third day in office. By executive order, he closed every bank in America. Can you imagine the President of the United States today? I don't care if it's, Biden or Trump or anybody else, Democrat or Republican, issuing an order saying every bank is closed as of now. We'll get back to you when they're going to reopen. And that's what FDR did. To break the banking panic, but he still had the deflation problem, and the Fed couldn't do anything. I talked to Ben Bernanke about this personally because Bernanke wrote a book on this, and I read the book, and I said, Mr. Chairman, I said, here's what I think you said. Did I get this right? He said, yeah, that's it. You understand it correctly. But the Fed couldn't and didn't do anything. So how did FDR break the back of deflation when the central banks were powerless? The answer is he raised the price of gold. He devalued the dollar against gold and raised the price of gold 75% from $20 an ounce to $35 an ounce. And that worked because it wasn't about rewarding holders of gold. In fact, he had confiscated all the gold beforehand, so it was like insider trading. But the idea of raising the price of gold was really to devalue the dollar so you could get the price of corn, wheat, steel, oil, get the price of everything else up. And it worked. In the middle of the Great Depression, from 1933 to 1936, the market boomed. I mean, the economy did very well, but it was starting from such a low level. It was still depressed, but it did much better. The Democratic theme song was Happy Days Are Here Again. Then in 1937, the Fed screwed it up again and caused a second recession in the Great Depression, and that's why they call it the Great Depression. But the devaluation of the dollar against gold worked. Nothing the central bank could do would work. Deflation is very troubling, and should be, to central bankers, economists, and everyday citizens, everyday Americans, because it raises real interest rates really steeply. It feeds on itself, and there's nothing central banks can do about it. And the only thing that has ever worked is devaluing the dollar against gold. So that's one reason to have gold. But we're looking at a global recession. And those are rare. As I said before, it's one thing if Germany has a recession or Japan or the US, but usually there's another economy or economic group that's doing okay or at least better and can kind of pull everybody out of the rut. But global recessions where everybody is declining are rare, and that's what's happening. And that's what we had in 2008. So the U.S. is heading for one. We've just talked about that at length. Japan's in a recession. Europe's in a recession. China's in a recession. India's, having some tough times. And a lot of this is dollar related. All the other countries I mentioned, Switzerland, India, China, Japan, have all seen their US dollar reserves go down. And everyone's like, oh, they hate the dollar. They're dumping the dollar. No, it's the opposite. They don't have enough dollars. So they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. So we're well on the way to a global recession. And if you say, well, you got communism, socialism, capitalism, all these different economic systems, all part of this globalized system, how could they all be on the same wavelength at the same time? Well, the common thread is the dollar. It's the US dollar. About 60% of global reserves, 80% of global payments. It's the benchmark for every other currency. So when you talk about the euro, you're quoting dollars. You're saying it's $1.05 or $1.04. Gold, you say, oh, it's $1,800 an ounce, whatever. The point being, even when you're talking about a commodity or currency that's not a dollar per se, you reference it in dollars. Same with oil, world market, it's all dollar oriented. So the dollar is the thread that runs through the whole global system. And it's a partial explanation for why everything's falling apart at once. What's the optimal asset allocation method? Well, the key is diversification. And when you say diversification, people roll their eyes and go, oh, of course, everybody knows that diversification is good and all that. But the problem is they don't understand what diversification is. And I run into people all the time and they go, Jim, I'm highly diversified. I own 50 different stocks in 10 different sectors, telecommunications, semiconductors, mines and minerals, consumer non-durables. So I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they're all going to go down together or go up together as the case may be. But particularly in times of stress, they become highly correlated. So having 50 different stocks or ETFs or whatever is not diversification. That's just having a whole bunch of bets in one asset class. So what does real diversification look like? Well, you should have some, 10-year treasury notes, or if they're a little too volatile for your taste, look at a 5-year note or a 2-year note. That will basically give you very, the credit secure. I'm not doubting the credit of the United States, but that will give you a deflationary hedge. If we get into disinflation and deflation where interest rates are coming down, which I do expect, you're going to get very good capital gains on those notes, or you're going to be very happy with the coupon in the meantime. Real estate, definitely. Not so much commercial real estate, too soon for that, but multifamily housing, residential real estate, farms, other kinds of income producing real estate for a slice. Good slice of cash, maybe as much as 30%. People hate cash. They go, I don't get a yield on cash. Cash is a waste of my time, etc. It's true that it has very low yield, but number one, it performs very well in deflation, which we talked about. But more importantly, cash is the opposite of leverage. It reduces the volatility of the rest of your portfolio. So if you have volatile investments in the wings, cash is it's like a bar connecting to two ends of the barbell. It has very low volatility, but most importantly, it gives you optionality. If you see stock markets crashing and burning the way I expect, the way I described, the person with cash can go out and go shopping in the ruins. And by the way, Warren Buffett Berkshire Hathaway has over $130 billion in cash. Why does Buffett have so much cash? Well, he sees what I see. We're looking at the same thing, which is a kind of meltdown where the person with cash can basically go shopping for bargains. Definitely a slice of gold for the reasons we talked about. That'll be your inflation hedge. But 10%, people always say, Jim Rickards says, sell everything and buy gold. I've never said that. I don't think that's a good idea. But 10%, yes, that's a good slice. Private equity, if you can have access to good deals, that's a separate category. And so a model portfolio, you'd have a slice of treasury notes, a slice of cash, have some stocks, but I would focus on, for example, energy, BP, Exxon, Mobil, Shell, Marathon, this Green New Scam thing, forget it. It's a big deal, from a policy point of view, but it's infeasible. I've studied the science very closely. It's going to go away. But in the meantime, if you bash the oil and natural gas companies, but you're going to need the oil and natural gas, which we do, then those stocks are going to do well. Real estate, I mentioned, and gold. So that would be a really diverse portfolio that would have 5 or 6 different asset classes. And some will outperform others. Some will do better in inflation, some will do better in disinflation. But that's the whole idea with this much uncertainty. And your winners will outnumber your losers. And cash is like a thermostat. You can reduce cash and buy a little more gold, or reduce cash and buy a few more stocks if that's warranted. So that's what I think an ideal portfolio looks like.